Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cencora Inc. quarterly report. Cencora Inc. offers a diverse range of businesses and services across the healthcare industry. The company's U.S. Healthcare Solutions segment provides various products and services to different types of customers, including acute care hospitals, retail pharmacies, mail-order pharmacies, medical clinics, long-term care facilities, and alternate site pharmacies. These customers receive generic and injectable pharmaceuticals, over-the-counter healthcare products, home healthcare supplies and equipment, plasma and other blood products, vaccines, specialty pharmaceutical products, and related services. Additionally, Cencora provides pharmacy management, staffing, consulting services, supply management software, packaging solutions, clinical trial support, product post-approval, commercialization support services, data analytics, outcomes research, and other services. The company also offers sales force services to manufacturers and provides various services to physicians who specialize in different disease states, such as oncology. Furthermore, Cencora's International Healthcare Solutions segment distributes pharmaceuticals, healthcare products, and related services to pharmacies, doctors, health centers, and hospitals globally. The company also offers specialty transportation and logistics services for the biopharmaceutical industry. In summary, Cencora, Inc.'s businesses and services include distribution of generic and injectable pharmaceuticals, over-the-counter healthcare products, home healthcare supplies and equipment, plasma, and other blood products, vaccines, specialty pharmaceutical products, pharmacy management, staffing, consulting services, supply management software, packaging solutions, clinical trial support, product, post-approval commercialization support services, data analytics, outcomes research, sales force services to manufacturers, specialty transportation. Logistics services for the biopharmaceutical industry, distribution of pharmaceuticals, healthcare products, and related services globally. Cencora Inc. Core has experienced a remarkable surge in its stock price over the past year, delivering a total return of 43.7%. This significant increase can be attributed to several key news events and positive developments that have taken place. One major catalyst for this growth was Cencora's strategic acquisition of OneOncology, which strengthened its position in the oncology and specialty pharmaceuticals market. The company secured $4.5 billion in credit agreements to finance this acquisition, further solidifying its presence in these areas. Additionally, increased demand for specialty medicines and GLP-1 therapies has contributed to stronger profitability. Cencora's strong financial performance has also played a significant role in driving up its stock price. For the fiscal first quarter of 2026, the company reported adjusted earnings per share, EPS, of $4.08, surpassing analyst expectations. This was primarily due to robust growth in its U.S. Healthcare Solutions segment, which saw a 21% year-over-year increase in operating income. Furthermore, Cencora's management raised its fiscal year 2026 adjusted operating income guidance to an increase of 11.5% to 13.5%. Up from a previous range of 8% to 10% growth. The company also projected revenue growth of 7% to 9% for fiscal 2026. Positive analyst sentiment and industry tailwinds have also contributed to Cencora's stock price increase. Analysts such as Morgan Stanley upgraded the company to overweight and increased its price target to $400, citing its strong position in specialty pharmaceuticals and the OneOncology acquisition. Additionally, positive news from peer companies and FDA designations have boosted investor confidence across the pharmaceutical distribution sector. In conclusion, Cencora's stock price has increased significantly over the past year due to a combination of strategic acquisitions, strong earnings, positive guidance updates, and favorable analyst and industry sentiment. Cencora Inc. market capitalization of $69 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that Cencora Inc. holds a significant advantage in their industry. Cencora Inc. trades at a higher price-to-earnings ratio of 42 times and a higher price-to-book ratio of 32.72 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The company exhibits a very high leverage profile, with liabilities accounting for 98% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress, we have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through the analysis of various business segments. In terms of revenue growth, the U.S. Healthcare Solutions segment has been a significant contributor, driven by overall market growth, unit volume growth, and increased sales of specialty products. Specifically, the segment saw a $3.7 billion increase due to these factors. International Healthcare Solutions also experienced revenue growth, with a notable increase of $4.44 billion. This was largely attributed to increased sales at the European distribution business. Additionally, other segments such as animal health and Brazil distribution businesses contributed to revenue growth. On the other hand, revenue decline drivers include loss of customers, which resulted in losses of a grocery customer and an oncology customer. Furthermore, operating expenses also played a role in offsetting the increase in gross profit at U.S. Healthcare Solutions, contributing to revenue decline. The net income of the company experienced a significant increase from $493.7 million in 2024 to $566.1 million in 2025, representing a 14.7% growth. This upward trend continued with an even larger jump from $620.4 million in 2024 to $708.6 million in 2025, marking an 11.9% increase. The substantial rise in net income can be attributed to improved revenue and effective cost management. In terms of profit margins, the gross profit margin saw a notable improvement from 3.15% in 2024 to 3.58% in 2025. Conversely, the operating income margin remained relatively stable at 0.88% for both years. The U.S. Healthcare Solutions segment also experienced an increase in its gross profit margin by 46 basis points to 2.47%. These changes suggest that the company's financial performance has been positively impacted by various factors, although the exact reasons behind these improvements are not explicitly stated. The company's financial performance indicates a concerning trend of negative operating cash flow. For 2 consecutive periods, the company has struggled to generate sufficient cash from its core operations. According to the provided information, this issue is explicitly stated on page 8 and further supported by other relevant pages, such as 30 and 32. The consistent negative operating cash flow suggests that the company may be facing significant challenges in managing its finances effectively. The company's debt level and interest expenses have undergone significant changes over the past year. In terms of debt level, there are mixed signals. On one hand, short-term debt has increased substantially from $117,785 to $342,276, while long-term debt has remained relatively stable. However, total debt has decreased by 3.3% from $7,921,735 to $7,660,773. Additionally, short-term debt has decreased from $116,361,000 to $51,769,000, and long-term debt has increased from $65,390,000 to $98,772,000. On the other hand, interest expenses have increased significantly. The net interest expense for 2025 is $72,409,000, a substantial increase from $27,933,000 in 2024. Furthermore, interest expenses have risen by $39.1 million, from $48.8 million to $87.9 million. These changes suggest that the company's debt level and interest expenses are becoming increasingly burdensome. Management is optimistic about the company's future prospects, stating that it is on track to achieve its financial position and business strategy. To drive growth, management plans to continue investing in new products, services, and related strategies. The acquisition of RCA is expected to have a positive impact on the U.S. healthcare solutions segment. In terms of capital allocation, the company expects to invest approximately $900 million in fiscal 2026 for distribution network expansion and technology initiatives. Management is also focused on maintaining working capital performance through metrics such as days sales outstanding, inventory on hand, and payable outstanding. This suggests that management is committed to efficient use of resources and optimizing cash flow. Overall, the company's outlook appears positive, with a focus on growth, investment, and operational efficiency. The company has made significant acquisitions and divestitures in recent years. In terms of acquisitions, the company acquired Retina Consultants of America, RCA, for $4,042 million in cash and contingent consideration on January 2, 2025. Additionally, it acquired OneOncology, LLC, OneOncology, for $4.6 billion on February 2, 2026. On the other hand, the company has also made several divestitures. These include the sale of a facility resulting in a gain, separate agreements with Alabama and West Virginia, and their subdivisions and Native American tribes, as well as a monetary award assessed against ABDC in Baltimore Circuit Court case. Furthermore, the company sold non-core businesses for $35.5 million loss on divestiture in 2024. Lastly, it impaired goodwill related to U.S. consulting services business classified as held for sale. The acquisitions and divestitures demonstrate the company's strategic efforts to expand its operations and streamline its business. The company has invested heavily in acquiring new businesses, while also shedding non-core assets to focus on core operations. The company's financial strategy has been focused on rewarding shareholders through both dividend payments and share buybacks. In terms of dividends, the company has a history of paying out to its investors, with a notable instance being the payment of $0.60 per share in 2025, which totaled $0.1 billion. This demonstrates the company's commitment to returning value to its shareholders. In addition to dividend payments, the company has also engaged in share buybacks, as confirmed on page 30. The company has invested a significant amount in buying back shares, with a total of $0.4 billion allocated towards this effort, as stated on page 32. This strategic move aims to increase shareholder value by reducing the number of outstanding shares and potentially boosting earnings per share. There are concerns about inventory buildup in the company's supply chain. The data suggests that there has been a significant increase in inventories over the past period. On page 30, it is noted that an additional $3.5 billion was added to support business volume and seasonal needs. Similarly, on page 31, another increase of $1.7 billion was recorded for the same reasons. This buildup in inventory has also led to a slight increase in days inventory on hand, DIOH, from 26 to 27.8. While this may not seem like a significant change, it can indicate that the company is holding on to stock for longer periods than necessary. This could potentially lead to cash flow issues and reduced efficiency in the supply chain. The accumulation of inventory can also be a sign of inefficiencies in the supply chain, such as overstocking or poor forecasting. If left unchecked, this can lead to further disruptions and costs down the line. Therefore, it is essential for the company to review its inventory management strategies and identify areas for improvement to mitigate these risks. That concludes the financial summary for Cencora, Inc. Feel free to comment below, and I will be happy to answer them when possible.